Can you tell us, technically, like, what are some of the issues that you saw, that you came to understand, that, brought you to that realization?
All right. So like I said this once, I'm going to say it again. IUL is sold as a very simplistic product when in fact it's hyper complex, right?
Right.
And so I actually just did a video the other day, and it was to this point, and it's when you think about index universal life, it's sold on upside potential, downside protection, with upside potential because of market participation through an indexing strategy, right?
Right.
Anybody who's ever looked at IUL, you probably understand that vernacular. And so the reality with IUL, and this is where it all falls down, the reality of it is that the market performance really has almost nothing to do. I'm not going to say nothing, but pretty close to nothing to do with the actual performance of the policy. And that is the challenge. That is one of the reasons I created the IUL challenge, showing that these things don't perform ever the way that they're sold. And the reason that I can make that challenge and know that these policies are not going to perform is because we just came through the greatest bull run in the history of the markets, right? Yet these IULs that are promising upside potential didn't provide upside potential in the greatest bull run ever. So if they didn't do it then, when are they going to do it? They're not going to do it. And so the question then becomes why, right? We got to ask the tough questions and go deeper and ask, okay, if that is the case, like, it's not some conspiracy theory. The life insurance companies aren't out to stick it to you. Right. It's not one of these things that a lot of uneducated advisors or agents on the other side that love whole life that hate IUL. It's not what a lot of them think, where they're saying, oh, well, they're reducing the performance so they can keep the profit. Life insurance companies are not doing that. That's not how they function. What happens is you have two components that are ultimately the driving forces of the performance of an IUL. You have an options budget, which is basically you put your money into a life insurance contract. You basically give it to the life insurance carrier. They put it into their general fund. That general fund is going to kick out a return. Let's call it 4.5%. Out of that 4.5%, a portion of that, let's call it 4%. And this isn't exact numbers, but just hypothetically, out of that 4.5%, the general fund's going to do, let's call it 4%. They create an options budget. That's the amount that they know they can get a return on your deposit. Let's say you have $10,000 of account value in your IUL, right? What they're going to do is they're going to say, okay, we know that we can create an options budget of 4% of that money. So they're going to take $400 out of that. That's how they give upside potential, downside protection. They're going to take $400 that they know they are guaranteed to get as a return with the bonds and the investments that they do in their general fund. And then they're going to buy call options with it. So the options budget is one component that is a driving factor. The other component are the options costs. And the reason that the last decade, even though the market's been booming, IUL performances have been getting worse and worse and worse is because it has nothing to do with the indexes. It has everything to do with the options budget and the options costs. And over the last decade, 2011, the general fund, the options budget for most of these insurance carriers was 6.5%. So that instead of a $400 options budget in this example, we would have a $600 to a $650 options budget. Now that may not seem like a lot, but we're talking 50+% increase in an options budget. So this adds up like significantly, right? And now we're lower. The other thing that's happened is that the options costs have gone up. So we've had this perfect world scenario, or like almost perfect storm in a negative way, where options budgets have been going down, options costs have been going up, and all the while the market's booming, it's irrelevant. It doesn't matter because cap rates have been coming down, participation rates have been coming down, spread charges have been going up. All the factors that make your policy perform well or not well have to get manipulated. Now, it's not that the insurance is manipulating them to kind of stick it to you as a policyholder. They're changing them because they just can't draw blood from a rock, right? If the options budget goes down and the options costs go up, well, then the cap rates have to come down because they just can't get you the big returns because you're not buying enough options to be able to quantify those results.
Right.
Does that make sense? Did I explain that clean? I mean,
yeah.
In my mind, but I realize it's like one of those things.
Yeah. That's so technically that's what's going on. Now, besides that, how about as far as, folks wanting to use a life insurance policy, to have
Mm.
early cash value access, right?
Yeah.
So
Yeah. No,
is that another concern or issue that you would?
totally. Like that's the other part about IULs that
Mm.
they don't talk about is like life insurance companies are all about risk control, right? And everything is actuarially done. And so the thing with IULs is because there's so many variables that they don't control, and they don't know what the market's going to be like next year, and so they have to be really careful and not expose themselves to too much risk, right? And because of the way that they do it, and these products are built, they have to create what we call surrender periods, right? Surrender charges with the policy. So, like for instance, in the example that I used with $10,000, if you got $10,000 in an account value and it's year one, you probably have like a surrender value of like maybe 3,000, right? So if you have a surrender value of 3,000, that means that's all you have access to. You don't have access to the full 10,000 because the rest of it is eaten up in a surrender period. And it's not that it's not working for you behind the scenes, but it's kind of like a 401k in a way. Like it's there, you just can't touch it, you can't use it, you can't leverage it. And the problem with that is there's like a level of smoke and mirrors or misleadingness to this because they're sold like they're this like great alternative to a 401k or something like that, like kind of a rich man's Roth, and you have access to it when in fact, maybe 10, 15 years from now, you'll have liquidity of it. But the problem is 10 to 15 years from now, it's not going to perform the way you thought it would. So you'll have less than you thought you would have. And all the while, the first couple of years, you're going to have less than you thought you had too because of the surrender charges
Right.
that go with it. And so,
So you don't
like,
have the early cash value that you're expecting, and then
right,
at
I
the
wrote
end,
this
you're not going to have the cash value results that you're expecting based
1,000%.
on so far
Yeah.
historical performance that can be verified and proven. You know what?
Yeah.
You mentioned it a little earlier about your challenge. Can you
Yeah.
go
Yeah.
ahead and put that challenge out for those that are watching or listening? What
I'd
is it?
love to. I'm like doubling down on this right now. And so the challenge is simple. It's simply saying, hey, I'm really tired of IUL agents trying to say that they're right and I'm wrong and whatever. I said, okay, if I know I'm right, first of all, and I know to the point that I'm right, that I'm willing to pay you if you can prove me wrong. And so I created the challenge saying, all right, based on a lot of the variables that we just talked about, I just show me a 10-year-old policy, a policy that has gone through the surrender period, which is typically 10 years, where the policy was sold. And by the way, once again, 10 years ago, we experienced a great bull run, right? So they should have just, if they're sold with upside potential, downside protection, they should have outperformed
Yep.
what they were sold as, right? Because they were sold with conservative illustration assumptions, right? That's how they're always talked about. And so when we look at that, I say, all right, show me the original illustration submitted, which is not hard to get for any agent that sold a policy. Show me the original illustration submitted with the policy, and then show me an in-force illustration 10 years down the road where the in-force illustration, meaning the current performance of that policy of here moving forward and the projections moving forward, match at least what was sold. Mind you, based on how they're sold, they should have outperformed drastically what they were sold as. But I'm not even asking for that. I'm just saying, just show me a match.
Right.
And nobody can do it. Nobody can do it. And it's not because of the market. It's because of everything we just talked about. The market is almost irrelevant when it comes to the performance of your policy. And I always kind of tell people, IUL is simply a universal life platform product with an options strategy attached to it. So if you don't understand the options market, you should not buy an IUL. If you understand the options market like deeply, and you then decide that the risk and all the stuff that goes along with it and you can manage it is worth it for you, then God bless, go nuts, but like that's not, nobody does that.
Yeah.
Like,
if you don't know what you're buying and you're buying something based off of, what
yeah.
sounds good, you're putting yourself at a very high level of risk for failure and disappointment. Whether it's an IUL or it's a car that you think has a souped up engine and it's really, a piece of junk. It's,
Yep.
it's smoke and mirrors, it's lies. So that's unfortunate that, those products are out there, that they're being sold like that, and so many people are buying them, and unfortunately, one day everyone they're gonna have to be held accountable at some point. Would you say?
Well, what's the most unfortunate part about this Seb, is it's not the agent's fault, right? I mean, it's the agent's fault from the perspective that, like, okay, we should all be digging deeper. We should never just rely on the carrier to do our training and our coaching for us. We should all, and that's whatever. But I can't necessarily say that I don't get it, right? Because I do get it. Because the real problem here, the real culprits here, are the companies themselves, because they create these products. Like, if we go back through history, it was the wild, wild west in the IUL space from 2009 to 2015. There was like very little regulation. You could illustrate products with astronomical assumptions. You could illustrate 4% positive arbitrage on policy loans, which is like mind numbing. Can you imagine running a life insurance illustration with 4% positive arbitrage on policy loans? There's not a better asset in the world that looks like it on paper. But that it just doesn't work that way.
Right.
But then in 2015, the regulators kind of grabbed hold of it, and they created what's called Regulation AG 49. Now, in 2015, they did that. They set some parameters in to kind of govern how illustrations had to be done. They put in the historical hypothetical look back model, which kind of like set the barometer of like what kind of rate of return can you expect. They did a couple other things. They reduced the positive arbitrage limit to 1%. But then what happened was, the agents are not the problem. The companies then said, all right. And like at this point in time, like, I'm not going to name company names, but there was two companies that like really went nuts when it came to creating other things like multipliers and other kind of riders that you could bolt onto the products that would make them illustrate really well, but they also injected more risk, which is completely the opposite of the spirit of the product, right? And so like, it's just people didn't understand it, and it was being missold, and it wasn't the agent's fault. It was the companies that were kind of like building these products and trying to get around the new regulation, right? And so like, then, from 2015 to 2020, that was all happening. And then finally 2020, they came out with Regulation AG 49A. They updated it to 49A, and they changed it a little bit more. But once again, carriers try to get around it, and they're building new products, and they created like the proprietary indexes, and they did all these things, which, like it just goes to show it. And the sales force, the people, the agents selling this stuff, they're just kind of repeating and regurgitating what the companies are saying that they should do. So it's hard to like, hold them accountable, when I get it. Like, if a big Fortune 500 life insurance company is saying, hey, this is what it is, blah, 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 this is how you could sell it, this is our history, this is expectations, and it's out of reality. But like most people are going to take that at face value. And so it's hard to fault them for that. But all I can say is like, look at the regulatory history. These companies are playing these illustration war battles, trying to win like this ledger battle to make them look really sexy on paper so they can sell more, realizing that they're never going to meet those promises. And agents are just kind of falling into it. And if you look at right now, Regulation AG 49A is in the process of being updated, and will be updated in 2023 here, to reduce it even more, to eliminate the ability for positive arbitrage. And they're actually reducing the ability to illustrate income to the levels that they are now. They're going to be reducing the income illustrations on IULs by up to 50%.
Oh, wow. Wow.
So when I talk to people, when people are like, Chris, you're wrong or whatever, it's like, if I'm wrong, like, let's use like take my opinion out of it, do some critical thinking for yourself, right? And just use some common sense. Like, my mentor, Brendan Burchard, used to say, common sense is very seldom common practice, right? Like, so let's take all the technicals, let's take all the industry jargon, let's take all that out of the equation and use two things of common sense, right? First of all, regulatorily speaking, would these regulators be changing this constantly and be fighting with the companies if there weren't a problem? The answer is no, right? So who are you going to trust? These companies that are just trying to like make money, or regulators that are trying to actually protect consumers, right? That's first. Secondly, when you look at an IUL and you look at an illustrative rate and they say, yeah, we can get you 6 to 6.5% predictable. Look at the cap rate, look at the market history, all this stuff. And it's a conservative number, because that's how most of them sell it. Like, you should be able to lean on that number on a pretty conservative basis. And so if you use common sense in that, and you say, all right, I'm giving my money to the insurance company. The insurance company is then taking that money and buying options based on a budget that's created, and they're doing that, and then they're going to get me this great return. Well, if the insurance company is having a hard time getting 4 to 4.5% for themselves, how are they? How in any common sense world do you think they're going to be able to get you 6.5% in that same world, which is basically more than 50% higher than the return they're getting themselves? How do you think they're going to do that for you on a predictable basis? If you think about it in those terms, you go, oh, okay, yeah, this doesn't make sense, And so it's interesting to me.
So, do you know if it's for a fact that do any banks or insurance companies actually own any index universal life insurance?
I'm sure there are some somewhere that do. I don't know of any specifically, but I do know of a lot of banks and a lot of corporations that own whole life insurance, and they utilize whole life insurance as a tier one asset on their balance sheet. And so from that perspective, um, I'm going to go with that all the time, because if you think about it, IUL doesn't really work as a tier one asset because it doesn't have the risk, or it doesn't have the guarantees. It carries more risk with it because of the surrender charges. It doesn't have the liquidity. So, these banks and companies aren't able to use it in that way. And so it just doesn't make sense when you look at the profile of the product and the attributes of the product. Let's get rid of the names. Let's get rid of, IUL versus whole life. Let's look at the actual attributes. Let's think about what you want to accomplish. Let's think about what problems you need this product to solve for you, and what role you need this product to fill in your life. And when you start looking at the attributes side by side, the story kind of plays itself out, I feel like.